Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm once again with my good friend Doug Heagren. Hey, Doug.
Good morning, Kirk. Good to see you again. Happy Monday.
Well, I guess today's Wednesday for our listeners, but happy Monday to you too.
Sometimes we record these things a little off schedule, so but you'll get to hear it on Wednesday. But happy Monday to you, Kirk.
Oh, good. So this week we are going to be talking about end of quarter. Since this is the end of the third quarter, the numbers have come out. We wanted to share those with everybody, and they look kind of ugly. So you might want to take your Prozac or whatever else you need to get through the day. But yeah, it's not pretty. But I want to go through them because I think everyone really needs to know what's going on. So Doug, as we kind of look at kind of what happened in the past week, there were some interesting charts you sent over. What do you want to start us off with here, Doug?
Well, I think what I want to a good place to start here is something, and we don't want to get a little too much into the weeds, but I mean, as most people know about the markets and kind of where things are currently has a lot to do with predictions, right? Sometimes it's reacting to what has already occurred, but many cases they're trying to predict what they see as the outlook, whether short, medium, or long term. And one of the things that caught my attention earlier this week, not to get too much into the weeds, is something out there that we call credit default swaps. And let's just simplify what that means. Is that essentially when there's borrowers and sellers, a credit default swaps would be like buying insurance against the lendee of failing to be able to pay their obligations. And so what we have started to see out there is that there has been an increase in the spread, and otherwise, really taking a look at how much risk those lenders are starting to foresee in the ability of lendees to pay back. And the U.S. banks have seen massive spreads on this, which is indicating incredibly, as bad as it's been. And we can look at some of those charts, there that showed what different asset classes have done over the last quarter, last year, last month. As bad as it's been, there does not seem to be any indication of reprieve coming anytime soon. As a matter of fact, there is some of the highest spreads that they've ever seen, especially when you start looking at those spreads between different lenders and lendees national lenders and lendees between, different countries out there, some of the highest they've ever been in history. And what that means right now is an extremely large concern that not only are we looking at on the private sector concerns over the ability to repay debt, but we're seeing that, what there's talk that the Lehman Brothers, Bear Stearns moments that had occurred, back in 2008 on kind of the private side, they're now talking that, about things such as potentially, economic disaster in England as being something, an area where you're almost fearing that there could be a Bear Stearns or Lehman moment on a national debt standpoint. And because of that, an extremely high amount of premium that's being charged right now in order to access that lending money to prevent the disaster of not being able to repay that debt. And that's certainly a very scary thing to see.
Yeah, no, I think it's a great point, Doug. I'm glad you brought it up. If you think about like the last 20 years or so, first we had the tech bubble, which burst and took most of the economy with it, but mostly the tech sector. Everything else was affected, but mostly it was centralized in tech. If you go to fast forward to 2008, it was the financial sector that imploded. Other sectors obviously got affected, but it was mostly the financial sector that kind of imploded. And you think about all the different things that have gone on. Certainly housing. Sorry, I didn't mean to miss housing in that 2008 scenario. But if you look back in these different crises, they were caused by leverage, they were caused by stupidity, they were caused by lots of different things that seem to repeat themselves in human nature. And right now we're into a period where really the problem is in fixed income. We'll talk about this in a little bit, but fixed income has had one of the worst periods since I think it was 1960 or 61. And it's pretty bad out there. And what Doug was talking about was basically the CDS, or the insurance on bond holdings of countries. Now, one of the problems that people are concerned with out there is that, you think you're investing in a country, that your debt's going to be safe, right? Well, I guess people who do that don't remember Greece, but that's kind of what the thinking is oh, it's a country, they'll bail us out, right? They're not going to default on their debt. History will tell you otherwise, but we're actually coming to a period where all countries are suspect right now, and it's not just one country that is going to default. It could be many countries, and they could be a cascading default, one after the other, for various reasons. Now, one of the impacts that I think is hard to predict are things that we cannot see, which is in the financial system. So it could be, we saw this in the after 2008 for a few different years, where there were implosions of different funds. So somebody's books were very poor, and they just basically imploded. And the financial system, the problem with it is sometimes it can take down other companies, right? Think 2008. You had Lehman Brothers, you had Bear Stearns, and then you had all these other companies like AIG, which was AAA rated, by the way, I will point out, which is the highest credit rating you could have. And there were only 5 companies in the world that had it, and AIG was one of them. And they got taken down. And oh, by the way, Goldman Sachs was also attached through other means, but they got bailed out because certain companies are more apt to get bailed out in financial crisis. So let's just leave it at that. But I do want to go on and talk a little bit about where we are now, what the consumer sentiment is, and we're going to touch on a lot of different areas, because I think ending the quarter, it's always good to kind of circle back and see what happened. So Investopedia, I'll give a shout out to Investopedia. They put out some good stuff. They did a survey.
Hey, Kirk, can I just add on something really
go
quickly
ahead,
on what you were going to say? Because you talked about the ratings organizations in AIG. Let's not forget that because of some of the issues that occurred with that rating, that they had to fundamentally redo a lot of the ways that those companies ended up rating, that they ended up getting put under quite a bit of scrutiny because they were maybe a little bit too in partnership with some of the companies that they're rating. So that caused, a lot of pushback. But you were also talking about Greece. And I think it's interesting because when you think of that Mediterranean region, Italy comes to mind as something very similar. And going back to the credit default swap issue, I mean, one thing I want to point out here is a lot of people are worried about the U.S. and the amount of spending that the U.S. has made. And I want to say on a positive note to address that, the U.S. is nowhere near one of the riskiest places right now when it comes to that debt or those credit default swaps. Matter of fact, on the list that that the chart that's posted, the U.S. is one of the countries that actually had some positive change, and the overall change right now from its high to its average is single digits, about 7, which puts it in the lower numbers. And again, not getting too much in the weeds here, but if you take a look at some countries like Italy, some countries like the United Kingdom, which as I mentioned, again, major concern. There are some every single country is outside of its average on what their typical pricing would be on those spreads of risk. But the U.S. is sitting much better than some of those other countries. I wanted to point out there where the real risk is. And, hey, this is one of those times, you might be saying it's lucky to be an American. So,
yeah. And just to point out from what Doug was saying, countries like Israel, Norway, Switzerland, and where's the other one? And Denmark are actually, holding their own reasonably well. There's some others, but I think, we can move back to some of the consumer sentiments, because I think we could, the sovereign bonds are a big topic, and we're going to come back to this over and over again, because I think this may be where we find the bodies at the end of this cycle, because there's a lot going on in currency markets and sovereign bond markets that are not apparent to a lot of people, but usually start to see it when the CDS market picks up. So that's what we're seeing. That's why we're pointing it out, is because this is an early indicator of future problems. But let's get back to the consumer part, because I think this is something that we can all relate to. Investopedia came out with a few surveys, and I want to point out a few of them here. So we're going to point out this chart. 1 in 5 readers, what would they do with an extra $10K in cash? Most people would just keep it in cash, oddly enough. And, you can see this chart here. Some of them, 11% would pay down debt, but most of them are investing it. So 20% in keeping it cash, 11% paying down debt, and the rest of them basically are investing it. Now, this is a similar bias that we talk about in the past, that there is a bias here for people to, buy the dip and put all your money in something. Sometimes cash is a good idea, right? Apparently 20% of the people thought so. But that means that minus the 11%, you're looking at what 69% are investing in other things. I think that's very telling for where people's heads are at. And I think we'll start to see that effect as we kind of move on into further into this crisis. The next one I wanted to touch on is another one which talks about inflation, recession, or interest rates for top concerns. Now, if you survey people, what this is basically saying is that most people are concerned about inflation, recession, or rising interest rates. There are other things like geopolitics, supply chain disruption. Those are further down. So I think people's head are in the right place in terms of what's really a top concern. Somehow 3% thought nothing, or 8% nothing, none of the above, which I always find fascinating. There's statistically, there's about 25% of every survey are people who are going to say the dumbest thing. It's like the exact opposite of what you think is rational. Always 25% will always be there. Any survey poll, you can't get more than 20 or 25% because apparently there's that many people that are, let's just say not logical. All right, let's move on. Just one or two more here, and I'm going to go back to you, Doug. So the other thing is, so also most readers are choosing to wait out the market volatility. 63% are choosing to wait it out. 47% still want to buy the dip. So 47% of the people need to watch and listen to this show. Do not buy the dip, okay? If you're buying the dip, that's where you're going to get your hat handed to you, okay? Buying the dip works in a bull market. It does not work in a bear market. A bear market, they say sell the rip, which means if it goes up, then you sell it. You don't buy the dip because that's really dangerous. And if you want to keep trying that, you'll see how dangerous it's going to be when that actually comes to pass. So, and the last one I want to point out before we get back to Doug is that we, let's see here. Oh, here, I want to point this one out. So this picture here of Prince William, it shows two angles of him. And I brought this out because this gets into, I love this picture because this gets into what we talk about here, which is half-truths, right? A picture says 1,000 words. Well, apparently it says 1,003 because, it's the way that people construct things, whether it's visually or videos, everything can be fake nowadays. If it's in the news, it's probably fake. This is not a fake news sort of MAGA sort of thing. I think anyone, whether you're on the right or you're on the left, if you don't realize the news is being manipulated, then you really need to wake up. And this is a good example of that. You take one shot of somebody, it looks like they're giving the crowd the finger. You take the other angle and he's showing the number 3 with his number of fingers. I mean, this is exactly the kind of things we point out, because you need to understand that the news, that the information you're being fed is doctored to elicit a narrative or a scenario that they want you to think. If you want to really know what's going on, then you have to really get the information yourself and make your own decisions. Don't let other people make the decisions for you and create a narrative, because that's how you get yourself into trouble. So just wanted to point that out. I thought that was a great picture. We'll add that to the notes. Doug, what else? What else do you want to point out here? I know there's a few more charts here.
Well, I got to start by saying I'm cracking up on the Prince William picture, because to me, there's so much being read in this, and I'm over here, I'm busting up because the first one, obviously can be interpreted as something very negative. The bottom says so in so many ways. This goes back to the old saying, "Read between the lines." And if you haven't ever seen people use that symbol with the 3 fingers, I think there's a lot of ways to read this. Read between the lines on how you're being manipulated, but you could also be reading between the lines in what Prince William's trying to tell people here. So I like this one. I can't stop laughing. It's maybe one of the best images that I've seen in a long time, Kirk. The other thing I wanted to go back is you touched on buy the dip, and I saw a couple things recently I want to point out here. I continuously see the conversation. Well, first of all, I saw someone argue and show a chart where buying the dip did not outperform buy and hold over the course of time. And I think, as you mentioned, Kirk, there's a lot of reason to argue that. But of the logic between that they were using in that chart was that if you were going to buy the dip, the caveat is you could never sell anything you bought, which I think is a highly twisted and manipulative way to say it. Because if you are someone that likes to buy the dip, and again, Warren Buffett does it with the cash that he builds up, he's obviously going to make strategic moves and occasionally sell. So I think, again, this charts can be twisted in any number of ways. Advice can be twisted in any number of ways. I also looking at something I constantly hear is, well, buy the dip. The best way to buy the dip is dollar cost average. But dollar cost average and buy the dip are not the same thing. Buy the dip is actually trying to wait for a time in which you jump in, put your money in, and buy it when the market has dropped, thinking that you've bought it on value, which, as you know, doesn't work if the market's going to plummet another 50%. You just bought in at less high before you lost everything. By the dollar cost averaging is not buying the dip. Dollar cost averaging is just allowing your money and your cash flow to systematically buy at all times. So you're not buying the dip, you're buying the rip, you're buying everything. There's no bias or strategy behind it. Don't be confused by the two things. Dollar cost averaging is great long term with regards to your planning, but do not confuse that as buying the dip. Other thing I think, wanted to get into, you mentioned the fixed income. We've talked about this a lot recently. I think one of the things that I saw recently is that 2008, basically the volatility ratio, I'm not going to get into the technicals on this, for the S&P 500, SPY, at that point in time was down a metric known as a metric of negative 1.84. Aggregate bonds, the AGG ETF, at this point in time, on a similar basis, is down negative 1.98. So what that means now, that stood out to me, Kirk, is that risk-adjusted performance of the supposedly safe fixed income, the thing that is helping to keep most conservative investors. So the elderly tend to shift their portfolios to more conservative. People that don't like risk tend to shift their portfolios to more conservative. What has been the traditional way of shifting your portfolio more conservative is getting out of stocks and having a higher allocation to fixed income. And unfortunately, the typical fixed income allocation is going to be to an aggregate bond index. And on a risk-adjusted basis now, bonds have actually performed worse this year than stocks did in 2008. So how's that for safety? And if you shift to some of these other charts that Kirk's going to show, it's been a brutal run in asset classes across the board. Surprisingly enough, micro caps, Russell 2000, mid caps have performed less worse over quarter and week than many other asset classes. You start to get into certain bonds, short-term duration, as we've been saying, has performed less worse than long-term duration. And of course, investing in other areas of the world, which we have identified that a lot of these countries are in some significant financial stress. What I thought was really interesting is inflation-protected bonds, something that is supposed to be right now a very good place to have your money in a extreme rising interest rate environment, has actually performed as one of the, along the lines of not near the worst, but definitely along the lines of the worst performing areas of fixed income. Zero coupon bonds, the worst, which again would be an area where you would think, based on durations, you would feel things have been better. I mean, as we've said, commodities, things that have been driven up by inflation have done well. But if you try to invest in inflation-adjusted securities, I know a lot of people are trying to, go out and maybe buy those I bonds. You like those I bonds, but other types of, risk-adjusted inflation-adjusted bonds have not actually performed as well as people would have thought. And so, I mean, this has been, and if you look at the performance of different S&P 500 areas, as they break those down into more growth weighted or equal weighted or dividend related, et cetera. Again, just absolute catastrophic moves in the market. And I think there's a lot more pain to come. So guess what? That still makes one of the best asset classes, Kirk. Cash.
Oh, wow. Haven't we been saying that on the show, Doug? Isn't that one of the asset classes we like?
I don't know. I've heard
Hmm.
this from people. Why am I sitting in cash? I'm not making any money. Just in the last quarter, you probably made 20% on where it could have been. So be patient and understand there's lots of clubs to put in your golf bag. And there are times that every one of those clubs is going to get you out of an errant shot in this game of finance. And right now, cash, cash is the safest way to put you towards that hole, an environment where, again, look at those charts. Anything and everything is having struggle right now.
Yeah, and Ray Dalio's well known for saying cash is trash, and I love Ray. I think he's doing great work, and he's putting a lot of great content out there. But that's just not the case. Cash is not trash. Cash is king right now. There will be a time where that's the case, but right now that is definitely not the case. Um, so I want to touch on two more areas. And I want to really quickly, and I want to jump into the quarter end numbers because I think it's important for people to contextualize what's actually going on. And for those of you who are not watching the YouTube channel, we'll have this up there, and also we'll have this up on our website. So if this episode's not up for a few days on YouTube, you can always go to our website and see all the charts. So I want to point out there's this chart here that talks about the affordable home at 30% of household income. And for those of you who don't know, 30% is kind of the magic number that a lot of lenders use to determine how much you can pay for your home. So this compares 2022 to 2020. And it shows basically what income is needed right now compared to what was needed in 2020. And for a number of these, they're double, like what we've been talking about in the show here, Doug, right? Is that as mortgage rates go up, the affordability goes down. So for the same house in my beautiful city of Boston, and 2 years ago, the affordable typical home was 99,000 and change. Right now, it's 170,000 income needed. So if you were making about 100,000 in 2020, you need to make 70,000 more a year just to afford the same home that you were looking at 2 years ago. And home prices have not gone up. They've actually gone down. So if you don't understand this, go back to some of our earlier episodes where we talk about how yield and price are inverted. As yield, in this case, mortgage rates go up, that means prices of the house that you can afford are going to go down. And this doesn't happen overnight, but it's going to happen, and it's going to happen sharply. And we're already seeing it in these numbers. Austin, Texas is top of the heap. Boston is number two. And who would have thought Boston was probably one of the more conservative areas, but there's other parts of the country which are certainly not doing well. But you can look at this list: Charlotte, Columbus, Ohio, Dallas, Texas, a bunch of Texas, Houston, Indianapolis, Las Vegas, LA, Miami. The list goes on and on. But you should really look at this list. I think it's a really telling list for what people should be thinking about for home prices if you're moving. If you're not moving, you can ignore this whole segment. But if you are moving, you really need to understand this inside and out. And then the last chart, which I pulled from Investopedia as well, which was new single family homes sold. If you look at it earlier this year, it was over 800,000. Now it's at 511,000. So it's clearly going down as rates go up. And this is going to spill over into everyone else with the economy. So just keep your head up, know what's going on with housing. Like I said, if you're not going to sell in the next 5-10 years, you can ignore it. If you are going to move, you really need to understand this, and you should make your decisions sooner than later.
Kirk, we showed on one of the last episodes that we were on how much there's been a shift from inventory, right? From some of the cities that had the most extreme availability of inventory to all of a sudden, to the lows of inventory to all of a sudden extreme highs of inventory, that houses are sitting longer. And this is one of the things, again, I don't want to alienate people out there, but sometimes as people get too close to the industry, they tend to have a difficult time seeing through the blinders that come from being so closely tied to it. The reality is, you hear this all the time. Well, there's just not enough homes. There's no way that homes can lose value. There's not enough homes. They're going to need more homes. The problem is there is an absolute cost to develop those homes. And with commodity prices having gone up, and those prices of land have gone up, all of those things become more expensive over the last couple of years with inflation to build. And so therefore it becomes incredibly difficult to build more homes, which of course keeps the supply down. But the homes that are there got so inflated because, just like you were talking about, it now takes twice the amount of income to be able to afford what you used to be able to afford 2 years ago. That cuts out massive supply, because anybody who is looking for a home, and people get emotionally, this may not be the greatest investment, the largest investment that people make in their life. It's one of them, but it is absolutely, hands down, for most people, the most emotional investment they ever make in their life. So you hear this, I can't get a home. I got to have a home. Everybody else is getting a home. I don't have a home. And if I'm going to have a home, if I don't get a home, then I'm doing something wrong. Okay. Because it's been trained into us that you've got to be able to go out and buy a home. So emotionally, as you start to see those prices go up, what happens is more people will be willing to pay those prices. And as long as they can pay more within their salary range, you're going to have that many number of people that are going to be bidding and driving those prices up. But when you cut out a massive segment of people that can now afford to be able to get money, and it's not just that they're making a conscientious choice not to go after that money, the banks aren't going to give it to them anymore, because the banks are looking at 7% interest rates, which we just hit last week in certain areas on mortgage. And you look at 7%, and the bank looks and says, how much of your cash flow will it take to pay the amortized payment at 7%? And they're going to look at you and say, you can't afford this anymore. That $800,000 home that you were seeing on that chart is now, we're only going to give you enough money for $500,000. So if you're trying to bid on an $800,000 home and you're trying to sell an $800,000 home, all of those people that used to be able to line up and try to buy that home now are only going to have $500,000 to come and to show up. That right there doesn't matter how many homes we need. We need housing. It does not matter how many homes we need in the United States. Right now, there is a lack of access to capital, and because of that, you're just not going to get the number of people demanding that home at that price to be able to keep the prices sustainable. It has nothing to do with how many people need houses. And that means home prices, as they've been saying for years couldn't happen, are coming down.
Yeah. Well, we're going to keep beating this dead horse, Doug, because, apparently I know a lot of our listeners are pretty smart and they probably get it, but, we get new listeners all the time. So we have to keep educating people to make sure that they understand this dynamic, because this is one of those significant things. This is a paradigm shift. Everything you think you know about finance is going to change. And, you're not even going to realize the things that are going to change. Like, you probably think there's like 5 things. Everything is going to change. Everything you think you know about finance is going to change. And unless you've sat down and thought through the whole scenario and how things are going to play out like we have, you're going to get surprised in a lot of ways. I'll get surprised. It's one of those things you can't always tell what's going to happen in a paradigm shift. You can tell a lot of it, but not all of it. Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist, because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes. In the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. So one thing I wanted to point out here before we kind of wrap it up is I want to get to the end of the quarter numbers. And I wanted to point these out today because we usually don't do this, but I wanted to point them out because I think a lot of people don't really understand what's going on, Doug. You know, they think that, oh, everything's fine. Oh, it's just some things that are down. No. We actually are gonna put up on the show notes in the website as well as on YouTube. We're going to show all of these. And I think you're going to be shocked at how bad it is. I mean, this is some of the ugliest charts I've seen in a long time. I'm just going to run through the numbers quickly. And then for those of you who want to go to the show notes, we have probably 100 different indexes and ETFs that will show you how the markets are actually doing. So I want to point out the major ones, and then I'm going to point out some bright spots. So as of the end of the quarter, the S&P, and by the way, I'm using ETFs. So the SPY is down almost 24%. The NASDAQ is down 32.5%. This is year to date. TLT, which is 20 plus year treasuries.
Hey, Kirk, I want to add in there for those that are not math majors that might be listening to this. What you just said is that QQQ, the NASDAQ, where most of the a lot of tech stocks reside, is lost a third of its value. Let that sink in for a second.
You know what's in the, you know what the biggest pieces of the NASDAQ are, Doug? FANG stocks.
Absolutely.
So
you know what one of the biggest pieces of the S&P 500 are? FANG stocks. So guess what? Almost everybody who thought they were diversified just by buying different asset classes and ETFs, and I've been trying to preach this for the last 5 to 10 years, you are not diversified.
Yep. And one of the biggest companies in that index actually just talked about how some of their sales are going to start dropping. So some of those have been holding up the indexes. So if they stop, look out below. So the long bond, the treasuries are down 30% this year. So if you think you're in safe treasuries, they're down 30% this year. So the Euro Stock 50 index, the FEZ, which is characterized by large companies in Europe, is down 32%. Gold is only down 9.5%. Okay, that's fantastic. Only 9.5%. And gold, and for those gold bugs who think gold's going to be your savior, that's an indication that it's not always the case, right? Sometimes it is, sometimes it's not. In this case, it's clearly not. Not saying it's not going to be in the future, but so far, gold has not come to the rescue of anybody. Now, let's talk about oil. Oil is up 20% this year. Woohoo! Except for the fact that if you weren't aware of what happened earlier, on June 7th, it was up 69%. Now it's only up 20. So that should tell you that commodities have not done well this last quarter. Did well in the first half, but not so far in the second half of the year. What about Bitcoin? Oh, well, we have a Bitcoin. We have the GBTC, which is basically it's 100% trust of Bitcoin. It's down 66.69%. So those of you who are holding Bitcoin, or at least at the beginning of the year, are in a little rough shape right now. But that's okay, because that, if you didn't know, Bitcoin historically drops around 70%. In the softer times. It'll go up a few 100% and then drop 70. That's very normal. So for those of you who think it's going to zero, it might. It's certainly, anything's possible, but this falls within the realm of normalcy for Bitcoin. So just something to be aware of. Also be aware that Bitcoin tends to be highly correlated with the NASDAQ. So if you think the NASDAQ's going to get worse, then you should look at your Bitcoin holdings. Next, we have China. China's down 29% this year, which I guess none of us are surprised because they've been doing poorly for a while. Small caps are down 25%. The ag bond index is down 14%. And then here's another one. So let's look at the difference between growth and value. So the Russell 1000 growth index is down 30.75%, whereas the value index is only down 17.78. Now, if you listen to all the other numbers I talked about, 17.78 is about half of everything else. So value has done a lot better than growth this year. Still lost money because equities across the board have not done well, but it's done a lot better than growth. So for those of you who think growth is the only way to go, you should look at some of the numbers. We've been talking about it in the show. If in terms of relative performance, relative meaning one thing compared to another, value is most likely going to outperform growth for the foreseeable future until we get back on a track of print and forget. I won't go through all these numbers, but I think you should go to the show notes and look through them. There are a ton of numbers. Almost all of them are ugly. Even in bonds are ugly. The only bright spots here are in some commodities, mostly in fossil fuels, although there are some in the softs and in wheat, uranium, not for the year, but uranium's done reasonably well recently. But, mostly everything's down just across the board. It all looks ugly. Some of you I actually put this chart in here that talks about S&P factors. Now, I put this in here because a lot of people talk about quant investing. They say, oh, well, quant investing is better because, you look at the numbers and you can predict the future by looking at the past. I put all the factors in here. You'll notice that it doesn't matter. Okay, got to say that again. Look at the numbers. They're all ugly. No matter what factor you look at, these are the major factors that people have. They're all ugly. Okay. Sometimes the wheels come off the bus. It doesn't matter where you're sitting on the bus. Okay. You're still getting in an accident. And that seems to be the kind of markets that we're in. If you look at global markets, everything's down. Some are really ugly. I mean, look at the Netherlands, down 64% this year. That's oh, wow, that's ugly. I didn't even see that one. There's some really ugly ones in here. But
Kirk coffee shop stocks must be really struggling.
Coffee actually is doing well this year. Coffee is up 16 basis points, just the commodity itself. Compared to everything else, that's actually pretty good. But I do want to point out there's 3 countries that are positive this year: Turkey, Brazil, and Chile. So something to note that not every country's down, although you could argue Turkey's not the best place to be, even though it's up 15.85% this year. The currency's not doing too well, and neither is hyperinflation over there. Or I don't know if it's technically, I guess it's technically hyperinflation at this point. So that's kind of an ugly place to be. And then the last one I have here is the sectors. So if you look at the sectors of the S&P 500, the only one that's doing well is energy, which is up approximately 23%. All the rest are down, and things like communications down 62%. That's pretty ugly. So I highly recommend looking at these, just seeing where everything is. It'll make you feel better about your portfolio if you're in equities this year, because everything's ugly. So if you're only down 15% and the Nasdaq's down 30, it'll make you feel pretty good, even though it won't make you feel good. But I just wanted to point this out because I think everyone needs to understand where we are in comparison, because you might look at one index and assume, oh, it's the Dow and that's the index. And I'm just going to go off on a little rant here because really nobody in our industry looks at the Dow. The Dow has 30 stocks in it. So nobody really looks at that as an indicator. There's nothing wrong with it, but it's 30 stocks. And there's something wrong with every index, the S&P, the NASDAQ, all of them. You can point something wrong with all of them, but 30 stocks, I think, is really not enough to give an indication of what's going on in the market. So, Doug, as we get close to wrapping up here, I want to hear final thoughts from you. And I just went through a lot. So what are your thoughts on all this?
Well, I was going to say 30 stocks, and it's 30 industrial stocks, right? So it does give an indicator of a certain segment of our economy, but clearly it cannot be used to give you a broad outlook of everything on 30 stocks. And so, I think I agree with you completely on ignoring that. And going back to the S&P 500 sectors, again, communications down 62%. Real estate down 43%, and that's been rapidly increasing on that front. Consumer discretionary, and that's a prediction of where you're going to spend money. You don't have to spend on things you like but don't need. That is down one of the worst this year, 43%. And technology, oh, here it goes again, is down almost 50% this year. So it's been rough. And I like that, as you mentioned, on the international side of things, I think it's really, really important to watch on the commodity side. Natural gas, it's up 40, almost 47% year to date. And we haven't gone into winter yet. Right. So I think, that's something we've talked about. We've already noted here that a lot of countries in Europe are in significant challenges. Go back to 2008. As bad as it was with Greece, a lot of countries had a lot more flexibility financially to be able to weather the storm, and a lot of countries took on that responsibility to protect their private industry. Now, the issues that they're facing are on their own books, and I think that again, countries, this is where the companies are. Everything runs through those nationalities inside their borders, and the fact that they've already ran into so many of these issues, the outlook. I think this is something, as I said, let's watch it, because that a lot of people believe that could be, a place where the next potential Bear Stearns Lehman Brothers moment is going to occur. And as we go into winter with commodity prices and heating, we could see a lot of volatility continuing through the new year, besides the fact that we've got the election. Last thing I'm going to say, I'm going to quote Dan Patrick on this one. If anybody used to watch Sports Center when he was on it, he would say this when watching sports, watching players: you can't stop him. You can only hope to contain him. Well, guess what, Kirk? I think that's the paradigm shift. You can't stop it. What's coming on in the economy right now that we're facing, you can't stop it. All you can do is hope to contain it. So be smart about your money. Make sure that you understand that sometimes the best asset class is not being invested, and being patient. Patient will be key in this one, because I'm already hearing it. I've heard people say, already telling me, why are we sitting in cash? Why would I want cash here? What's the clean plan for this cash? You look around right now and you're sitting in cash and the market's down 22%. That cash made 22%. And that's before you start comparing it to, the Canadian dollar, or to the pound, which is now worth less than the euro used to be worth, which is now worth less than $1. So if you compare the US dollar to other currencies, you're absolutely making money. It's time to go travel internationally. But if you compare it to where your money could be in the market, you've made every percent those asset classes are lost. Understand this. It is critical. Watch what's going on. Don't wear blinders. Understand there is more challenges that we have yet to face, and that patience is key right now. So, speaking of patience, one thing you can't be patient about is if you have a child who's going to turn 18 and be looking at college. So, Kirk, I want to take this as a moment to plug my entity, ProCollege Planners. Families want to know where the money is, but more importantly, they want to make sure that their child gets into a school that's the right fit, that they're going to thrive and transform from college and from being a child into an extraordinary future as an adult. Walk off stage on Friday, collect that diploma into their career on Monday. We can help you do that. Find the right fit school academically, financially, socially. Build a plan to help you pay for it. Save you from spending hard-earned dollars that you would necessarily have to, because once that money's spent, it's gone forever. There's a plan for that. Look us up, procollegeplanners.com.
Once again, thanks for joining us, Doug. And just as a plug for college, you sent me a really funny TikTok video, which I'm also going to put in the show notes. It's hilarious. So those of you who enjoy humor, as we do, please go there. It's I find it kind of funny. So yeah, as we kind of wrap it up this week, I do want to put another plug in for our free money promo. For those of you who are not aware, we're giving away free money. So check out our website and you can get the details there. You can sign up and it'll show you how you can get your access to your free money. Also to get in the room. We have something else coming up in November, which I think you're not going to want to miss, but you'll get access to that once you sign up for the free money. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.